matters relating to the sale of the promissory note bonds. Mr. Dermot O'Flynn, Ballyhea Campaign Group, and I know you're joined by Deputy Collins this morning and your other colleagues. So I want to invite you now, Mr. Flynn, to make your opening statement, please.
Thank you very much, Mr. Chairman. And first, on behalf of the Ballyhea Says Know group, I'd like to thank you for the opportunity. We've had many significant days since this began, but this is probably the most significant day yet, because this allows us to ask you directly to please finish what we've started, to at least challenge the ECB on the injustice that has been done to Ireland and the injustice that is still being inflicted on us. And I would like also at this point to pay tribute to the work of Fiona Fitzpatrick in securing the stage for us, who unfortunately, and due to circumstances beyond our control, can't be with us here today. The reason Ballyhea Says Know exists: there has been much coverage in the last few weeks of Anglo-Irish Bank and events in the build-up to the banking crisis in Ireland. There has been no coverage of the ongoing consequences of those events. And I'm not speaking just of the billions in interest that we will be paying every year for many decades on the loans taken out to repair that damage. I'm speaking of the promissory notes Anglo debt legacy, the €500 million destroyed by our central bank in 2014, the €2 billion in 2015, €3 billion in 2016, €4 billion in 2017, and the €1 billion that we know of destroyed so far this year. That's €10.5 billion destroyed by the Central Bank of Ireland since 2014, and a further €3 billion in each of 2011 and 2012. That's €16.5 billion in total, with another €14.5 billion still to go, €31 billion in all. Ballyhea Says Know began in March 2011 simply as a protest against this socialisation of private bank debt, this massive bill presented to the people for the greed and excesses of so many in the financial private sector. We realised very quickly that we were going to get nowhere simply by protest, so we morphed into a campaign group. We went to Brussels 3 times and met senior officials from all 3 major institutions: the Commission, the Council and the Parliament. We went to Frankfurt to the ECB headquarters and presented a petition to a meeting of the Governing Council and nailed our own list of protests to the door there in the manner of Martin Luther over 300 years earlier. We sat down and spoke directly to senior ECB officials in Dublin. We met the Governor of the Irish Central Bank on 3 separate occasions. We had a private member's motion introduced in the Dáil, and all this was backboned by a weekly march in Ballyhea and in Charleville, joined by others in such as Ratoath, Dublin, Tralee, Clonmel, etc. And through all those actions, we learned 2 outstanding lessons. First, there is a willingness by the institutions to engage with Ireland on this issue. But second, and willing as we are, that engagement will not be with the Ballyhea Says Know campaign. It has to be at official level, which is principally why we're here today, to ask the Dáil to please set up a cross-party committee and to take this fight to Europe on behalf of the Irish people. And the fight it will be. We're under no illusions on that score. Background to a crisis. The currency requires many fundamental structural elements to enable it to withstand the shocks it will inevitably face. And when the euro was being designed through the 1990s, and as politics took over from monetary common sense, member states, understandably, point-blank refused to make the kind of sovereignty concessions such a common currency absolutely requires. And one by one, many of those critical supports were removed, to such an extent that when the inevitable shocks came, the currency would inevitably collapse. And this isn't coming just from the Ballyhea Says Know campaign. This comes directly from those who were up close and personal with that euro design. In the early 1990s, Bernard Connolly was head of the European Commission unit responsible for the European monetary system, the fledgling euro. In his book, The Rotten Heart of Europe, The Dirty War for Europe's Money, published in 1995, Connolly warns at length of the potential consequences of what was happening, and for his pains, he lost his job. Though his professional credentials and expertise in this area can't be questioned, and he now operates very successfully in New York, it has been argued that Connolly is a sceptic and thus this colours his views. But no such accusation could be levelled at Paul de Gruyter. Highly respected and oft used by the Euro Commission itself, a professor at the London School of Economics, de Gruyter also warned of the disastrous potential consequences if the euro was launched with those inbuilt flaws. In an article published in the Financial Times in 1998 titled "The Euro and Financial Crisis," he predicted almost to the letter what happened in Spain and in Ireland. Suppose a country, which we arbitrarily call Spain, experiences a boom which is stronger than in the rest of the euro area, As a result of the boom, output and prices grow faster in Spain than in the other Euro countries. This also leads to a real estate boom and the general asset inflation in Spain, and since the ECB looks at Euro-wide data, it cannot do anything to restrain the booming conditions in Spain. In fact, the existence of a monetary union is likely to intensify the asset inflation in Spain. Unhindered by exchange risk, vast amounts of capital are attracted from the rest of the euro area. Spanish banks that still dominate the Spanish markets are pulled into the game and increase their lending. They are driven by the high rates of return produced by ever-increasing Spanish asset prices and by the fact that in a monetary union they can borrow funds at the same interest rates as banks in Germany, France, etc. After the boom comes the bust. Asset prices collapse, creating a crisis in the Spanish banking system. That was Paul de Gruyter in 1998. In 2013, he published a paper titled Design Failures in the Eurozone, Can They Be Fixed? Another article in 2015, Design Failures of the Euro. Then there were other articles such as Milton Friedman in August 1997, Martin Feldstein in November 1997, and they argued likewise that design was fatally flawed from the outset. And all the above is proof positive that the euro as designed should never have been launched. And when it was, all that was predicted by de Gruyter, all that was warned of by Connolly happened. And Ireland, as we know only too well, was particularly hard hit. Billions poured into the country. Banks, trying to keep up with each other, with Anglo to the fore very early on, lowered their lending standards. Regulators and central bankers lowered their guard. Property prices ballooned till eventually it all exploded. The ECB, according to its own website, the ECB manages the euro and frames and implements EU economic and monetary policy. Its main aim is to keep prices stable, thereby supporting economic growth and job creation. What was it doing as the various bank crises developed all across the eurozone? What was it doing on keeping prices stable on property as property prices inflated to ludicrous levels in Ireland especially, but also in Spain? And while regulators and central bankers ignored the kind of major breaches of legislation, such as those reported by Jonathan Sugarman here, where was the ECB? Neither seen nor heard. That all changed after the crash, and how it changed, as the ECB suddenly appeared front and centre, the Commission's enforcer as the Troika came to town. One of the first measures taken to address the banking crisis was the establishment of the Emergency Liquidity Assistance Funds, the clue for which is in the name. The ECB website states that ELA aims to provide central bank money to solvent financial institutions that are facing temporary liquidity problems. The Irish banks, however, did not meet this criteria, but came up with a way around it. Using the Asset Covered Securities Act of 2001 and the Asset Covered Securities Amendment of 2007, they applied pre-crash historic valuations to the assets they held on their books, and this is in direct conflict with the most fundamental of accounting laws, which require that a true and fair reflection of the state of affairs must be presented. A quote from an Accountancy Age article in June 2014. The true and fair accounting concept should be used to override compliance with reporting standards in exceptional circumstances, the UK's reporting watchdog has said. In a statement, the FRC, which is the Financial Reporting Council, reconfirmed that the presentation of a true and fair view remains a fundamental requirement of financial reporting, and said that in the vast majority of cases, a true and fair view will be achieved by compliance with accounting standards. However, where compliance with an accounting standard would result in accounts being so misleading that they will conflict with the objectives of financial statements, the standard should be overwritten, the FRC said. The requirement to present a true and fair view in financial statements is enshrined in EU and UK law, said Stephen Hadrill, Chief Executive at the FRC. So those hugely inflated values hid the true position of the Irish banks in the lead-up to the infamous blanket bank guarantee, and they hid that position again when applications were made for funding to the tune of billions from the ELA funds. And as we were to finally discover in late 2008, those banks weren't suffering temporary liquidity problems. Had the true and fair valuations been used for the property collateral, they were in fact insolvent. Probably the most strict, and this is the promissory notes. The most reckless of all the Irish banks through this period was Anglo-Irish Bank, a point driven home with the publication of the so-called Anglo tapes, and the eventual cost to this country is enormous. €35 billion poured into Anglo, 25.5 by way of promissory notes, with a further 5.5 for INBS. That's 31 billion total. And these were quite literally notes signed by then Finance Minister, the late Brian Lenihan, offering a guarantee to the ECB on behalf of the government if Anglo should fail to repay those billions. But given how Anglo was disguising its true true financial situation. Those guarantees were offered under false pretences. Given that the ECB, as the central bank of central banks in the Eurozone, should have been aware of this misreporting, those guarantees are null and void. And yet, under enormous pressure from the ECB, that is the €31 billion currently being borrowed by the NTMA, given to the central bank in exchange for the P-Note bonds and then destroyed, taken out of circulation. This ongoing obscenity must end. At the very least, it must be challenged, which brings me back to the start. Myth-busting. The Troika's intervention in Ireland in 2011 is presented as a bailout for Ireland. It wasn't. It was a bailout by Ireland of the Eurozone, a bailout in which successive governments were strong-armed by the EU, Germany and France especially abusing their combined political and economic muscle. Including the €5.5 billion from NAMA, we poured a mind-boggling total of €69.7 billion into our banks, a world record of the undesirable kind. Against that, we got loans, not gifts, of €67.5 billion from the Troika, and loans at inflated rates at that. And then you have Germany, which we're told is the rock of financial sense. All those interventions by the ECB weren't to save Irish banks, it was to save the mega banks in the bigger EU countries. A Bloomberg article from May 2012 quotes a Bank of International Settlements report which outlines how German banks had amassed claims of $704 billion on Greece, Ireland, Italy, Portugal and Spain, much more than the German banks' aggregate capital. In other words, they lent more than they could afford. And when the European Union and the ECB stepped in to bail out the struggling countries, they made it possible for German banks to bring the money home, which is exactly what has happened. As a result, they bailed out Germany's banks, as well as the German taxpayers who might otherwise have had to support those banks if the loans weren't repaid. Unlike much of the aid provided to Greece, the support to Germany's banks happened automatically as a function of the country union structure. And in Wall Street also, they were in way over their heads. And this is exposed by Michael Lewis in his brilliant book, later a film which I'd recommend to you all, called The Big Short. And this is the final piece, the burden sharing. We accept that when the bank crisis hit, the ECB and everyone else involved faced an emergency situation, and they took emergency measures to save the Eurozone's banks, some of which meant a very loose interpretation of rules and regulations. We accept also that as a full member of the Eurozone from day one, Ireland must share the cost of what happened. What we don't accept is that the banking collapse was Ireland's own fault, and it was most certainly not the fault of the people. What we don't accept either is that Ireland's own bankers acted any worse than bankers elsewhere, and certainly were no worse than bankers in Germany. And what we won't accept, now or ever, is that we should be forced by the EU, and by the ECB in particular, to bear a disproportionate cost for that banking collapse across the Eurozone, a cost that has a direct impact on all the current crises being suffered in this country, from homelessness to housing, to what's happening in our health services, and all points in between. We've taken this as far as we can, and it has not been easy. And today, as the Irish people's elected representatives, we're asking ye to please step forward and take over this campaign from us, a cross-party committee to right a wrong that has been done to all of us in this country. Those promissory notes must be challenged. Thank you.